I want to walk you through a trade that I placed today, August 24th, 2024. This is a trade that I place nearly every day. The beauty of this trade is it doesn't matter if the market's going up, if the market's going down, or staying flat. The trade adjusts itself to whatever the market's giving us. So far in 2024, this trade has a 77% win rate, meaning 77% of the time, the trade ends the day profitable. This strategy this year has returned over 200% based on the max drawdown. The max drawdown is about $4,000 of a one lot trade. What this trade is placing an iron butterfly trade on the SPX using Zero DTE Options, meaning at the end of the day, the options expire. So essentially, this is a day trade using options. The very first rule of the trade is I open the trade every day at 10 a.m. Eastern Time. An iron butterfly is like an iron condor with no gap in between. The two short strikes are the exact same. So in this case, the short strike is 56.20. And so at 10 a.m. Eastern Time, the SPX was trading around 56.20. So we use the current SPX price as the center point of the iron butterfly trade. Then, for protection, we put on wings on the call side and on the put side and on the call side. We make these wings 20 points wide. So the max risk on either side is about $2,000 per single lot, minus the credit we received. So as you can see on this trade, we placed this iron condor at 10 a.m. Eastern, and we received a credit of $13.50. Since these are 20 wide, our max loss at this point is going to be $20 minus $13.50. That's our max loss. Moving on to this chart here, this is what the trade kind of looks like. So this is using West Coast times here. So 10 a.m. Eastern is 7 a.m. So this is where we put the trade on. You'll see this, the center line is where the center of our iron butterfly is. And we just let the trade go. And so what we did at this point, after the trade filled, we put a closing trade in. And you'll see this is a closing trade of $7.30. So we brought in $13.50, and we want to buy it back for $7.50. So I put on this debit, and if the market stays flat, at some point, we're very likely to close this trade at that debit. However, today, you'll see the market kind of drop down. And these upper blue lines here are the break-even points. So what I do is when the market punctures one of the break-even points, as it did here on the put side, this is a signal to change up the trade. What we're going to do is sell the put side of this, leaving the call side on. So what we're going to do is convert this iron butterfly into a call credit spread. So as you can see here, this debit order they had on got canceled. And this got canceled right around 10:49. And if you look on the chart here, it's right around 10:49 there. At 10:49, the SPX crossed that lower put break even, and we closed the put side. So what we did was we placed an order. We canceled our debit spread for the entire iron butterfly, and then we placed an order to close. We placed an order to close the put side. And we do this at whatever price the market's at. So you see the market was at $12.70. I actually got filled at a better price. So it filled at $11.70. So at this point, remember we brought in a credit of $13.50. And then we just spent $11.10, to close out the put side. So at this point, we have a credit spread on. And you'll see the credit. So we just have that credit spread on. And what I do is I place a debit for the credit spread at 15 cents. So when this trade is all said and done, I received $13.50 per share. I spent $11.10 per share to close out the put side. And then again, I'll spend 15 cents per share to close out the credit size or the call side. And so what's left of that, which is about $2 or so, is your profit. Something to know about this trade, when we convert it from the iron butterfly to the call credit spread, we're actually putting on a lot of risk. we have a $20 difference between the two legs of the call credit spread. So we went from a max risk that wasn't a whole lot of money with the iron butterfly to a max risk that was much higher with the call credit spread. That's something you have to be aware of with this trade. When you make that adjustment, you are adding more risk. But a couple things happen. One, the market's already kind of showing its hand. So in this case, the market was already kind of having pressured to the downward side. So you kind of have a pretty good chance that the market is going to stay low. That's when the losing part of this trade comes in, is if the market comes down, reverses, and goes back up. And that can happen, and that's when you have losing trades. But as we know, we have winning trades 77% of the time. And the return on these trades are roughly $250 per lot, per single lot on a winning trade in this market. And in a high volatility market, it can be as high as like $500. So it doesn't take very many days of wins to give you enough padding to offset the days of losses. So anyway, wanted to show you how that trade works. It's a trade that I place almost every day, and so far it's been a really, really great trade this year.